Okay, hi everyone. Thank you so much for bearing with us during our technical difficulties. My name is Semra. I just want to shout out to a few people who helped put this workshop together. So first and foremost, Nancy Chapman for helping us secure funding to host this workshop. Mary Nguyen, who is awesome and working on the back end of this to make sure everything runs smoothly. And then obviously Sarah Burnett Pierce, who will get started in just a minute. I will be monitoring the chat. Please use the Q&A function if you want to submit questions. And I'm hoping that we'll have plenty of time to answer questions at the end. This will be recorded and posted. So if you need to walk out at any point, it'll be made available on our website. So with that, I'll go ahead and introduce Sarah Burnett Pierce. Thank you.
Hello. Okay, I'm going to flip through these first few slides rather fast so we can kind of get caught up and back on track. But thank you all for coming today. I hope that the presentation is helpful. All right, there's my bio. You can read that later. There are 4 different types of tax preparers: the paid tax preparer, the enrolled agent, the certified public accountant, and the tax lawyer. And each one of these designations has different requirements that they have to meet. The significant difference is that the paid tax preparer does not have to have any formal education or take any exam or have any kind of certification. You can just put your sign out and start preparing taxes. They also have very limited to no, depending on how they register with the IRS, capabilities in representing you before the IRS. So if you have any questions or issues with the IRS, they are not able to help you. You have to have an enrolled agent, a CPA, or a tax lawyer. And you can read through the different credentials that each one of those has. Basically, the education and the certification just gets more stringent as you move up the line. If you have some very extreme tax issues and have to go to tax court, which is very unusual, particularly for people in our income bracket and business structure, you will need a tax lawyer, but it's unusual that any of us would need one of those. So what type of tax preparer do I need? Well, that depends. And this is a common answer that accountants and lawyers give to their clients because there are so many factors at play that, do I need to move closer? That you never want to just give a definitive answer to a broad question. But there are good and bad preparers in every group. I work with a tax preparer who is not an enrolled agent, CPA, or tax lawyer. She has been working 20 plus years, and there are lots of types of returns, particularly estate returns, trust returns. She knows a lot more than I do. I am an enrolled agent. I took the exam. I have my certificate. I can represent people in front of the IRS, but there are areas that she takes care of. There are areas that I take care of. It's more about the tax preparer's specialty, what area of tax regulations they've chosen to focus on. That's more important in choosing your tax preparer than it is what their certifications are or their education level. Price can be a factor. The higher the education and the certifications, the more expensive they're going to be. But basically, you need somebody that you feel that comfortable with, you feel that you can trust, that you can share situations with, even if they're a little bit uncomfortable or you think maybe you messed up on something. You need somebody that you can discuss those things with. Here is a question that was submitted earlier. How do I find a tax professional experienced in farm taxes? I find that references from people that you know and trust are a good route to go. Most tax professionals that are focused on farm taxes tend to be in the smaller towns outside of Kansas City. So the urban farmer may need to plan on driving little ways to find someone that's specializing in farm taxes. If you have other things on your tax return that investments, another business, a job where you're working remotely, things like that, you may need somebody that has a broader view than just farm taxes, which most farm tax accountants have that. But again, choose somebody you feel you can trust. Okay, do we have any additional questions about tax preparers? Okay, I think we're getting caught up here. The first thing that a lot of people need to determine in small farm operations is it truly a business or is it a hobby? And sometimes it doesn't matter if you feel it's a business, it's if the IRS says that yes, this meets the business parameters. And they have their 9-factor test that you can go through the 9 points and determine if it is a business or a hobby. But this 9-factor test is a very bureaucratic way of saying, is the main purpose to make a profit? And for us on our operation, we have the farm. We also have Of the Earth Farm Distillery. So we have a couple different enterprises going. The distillery has its own farming operation. But for the joint sheep flock that Jim and I have, our motivation is to make a profit. I am out there on a regular basis trying to improve the herd. I keep records on breeding. I keep our income and expense records and all of our tax documents. I'm focused on making a profit and growing that part of our business. Now, also on the farm, Jim has his horses, which they're Belgian draft horses, and they are for pleasure. Jim spends quite a bit of money every year on vets and having the farrier out and different things that you need to deal with the horses. He does occasionally use them to do some tilling and things like that in our garden plots. We do sell some of that produce from the garden plots, but the horses themselves are not our main source to work the garden plots. So they are not part of the farming operation, they're a hobby. So those are things to consider if you're setting up a business or you're considering farming, or maybe you've been farming for a while but aren't really making a profit. You need to look at if it actually is a business by the IRS standards. And the reason that it is important to determine this is because the IRS can say, okay, you haven't made a profit for 10 years in this enterprise. And so obviously something's wrong. It's maybe not a business and it is a hobby. And they can tell you, you have to classify this as a hobby. It's particularly important because farmers get extra tax breaks and things that a lot of other industries don't. And so in farming businesses, we have to be extra careful on if it is a hobby or if it is a business. Okay, any questions on that? Am I going through too fast? I see some frowns. Okay.
It's really good.
Yes, Nancy.
So is it, I know like in horses or something, you have to make like a profit in 2 out of every 7 years.
Right.
Is there something with vegetable farming that?
Any business structure, whether it be a car mechanic or a farming operation, the general rule of thumb is you need to make a profit in 3 of the last 5 consecutive years. They don't have to be a profit in 3 consecutive years, but 3 out of 5. Now, there are situations like with our sheep flock, we had a huge predation issue a few years ago. I had been using guard llamas. They were not sufficient to our new bobcat predators. And so I've had to spend the last 2 years training a guardian dog. I've winnowed down the sheep flock to just enough. I have 6 ewes right now because they are only there to train the dog. Then I'm going to buy back in and increase our flock again. So the last few years have not been profitable. But my years before that were profitable. I anticipate my years after that are going to be profitable. So even if I get audited or I get a letter from the IRS and say, what are you doing? We think it's a hobby, not a business. I can probably prove to them based on the circumstances that it is a business. So again, it depends kind of thing, but rule of thumb is 3 out of 5 years. You need to make a profit. Okay, a question I get a lot whenever I'm talking to small business owners and talking to people wanting to get into farming, do I need an LLC? Which I'm always hesitant to answer this question because this is a legal question, not a tax question. I can't give legal advice. But I have a very nice chart here that was provided by one of my tax classes that explains the difference between the LLC, how it impacts your tax treatment, and if you really need one. Because since an LLC is a legal structure and not a tax structure, you can see on the chart that for the sole proprietor, they have different LLC choices on how they set up their business, and then they have their tax treatment. Same way with 2 or more people that are in a group together, they have their business structure and their taxation. Now, if we just do away with the LLC portion, it doesn't change our business structure or our tax treatment. We can still be a sole proprietor, taxed as a sole proprietor without an LLC. We can set up an LLC for an extra layer of legal protection, but it does not have any bearing on your tax treatment. So again, this is not legal advice. It's the story of our businesses as an example. But, oh, and I forgot to mention on that slide, you also have a qualifying joint venture down there that cannot be an LLC. They're not allowed to be one, but their tax treatment flows through and is the same. So Jim and I share ownership of the sheep flock. He owns a small portion, I own most of it, and we file our taxes as a qualifying joint venture. We cannot be an LLC under this structure. But that's fine for us because I raise sheep to sell for meat. And so most of the time I have lambs, I raise them up, I sell them at the livestock auction, or I sell them directly to the packing plant. People are not coming onto my farm to look at the sheep typically. I do not have helpers. I manage most of it myself. So my liability is very low. Also, your typical farm liability insurance policy that we have to have because our house is on our farm, and so they make us have a liability policy. It covers most instances. So I feel like since our risk is so low, there's no point in having the extra hoop to jump through of having an LLC. Now, we also have Of the Earth Farm Distillery. We sell products wholesale, retail. We're at the city market. We have the tasting room with the patio. We have live music. People are coming. They're on the patio. They go out into the orchard and look at the fruit. They're around. The possibility of someone having one too many cocktails, going out and walking in the orchard and falling down and hurting themselves, which does not happen. People usually are pretty responsible, but it is a possibility, and people tend to think, oh, distillery, money, we'll sue them and get lots of money, which I can assure you distilling is not that financially fiscal. But since we have much greater risk, because we also have product liability and all this sort of thing, we have formed an LLC. It is taxed as a partnership because it's just Jim and I. We could have other members in our partnership. We haven't at this point. We could also have an S Corp and have additional protection, but we've chosen just to go with the LLC, taxed as a partnership. Any questions on LLC? And we're going to go over the business structures in a minute. This is just on the non-legal advice, well, you get the point.
There's a question in the chat. If it's a hobby, does that mean I don't need to file taxes on that part of it?
Okay, that's a good question. If it's a hobby, do I need to file taxes? All income is to be reported to the IRS, whether it's a side hustle or a hobby or a business, all income. Hobby income, the restriction on it is you cannot take a loss. So if you earn $500 in your hobby and you spend $800 in your hobby, you cannot deduct $300 from your taxes. you can zero it out so you don't have any income to report. But with a business, you could take that $300 and reduce your final taxable income. With a hobby, they don't allow that.
Well, okay, I have one more question.
Uh-huh.
How would you separate business from hobby if animals share feed, housing, etc.?
That is a very good question. I would, if there are different ways to do it, you can prorate things. If you have 10 sheep that are your breeding flock and you have 2 sheep that they've been around forever and they're pets, then you can prorate the barn, prorate the feed based on rations, that sort of thing. You would want to keep good records on that. You can also, as far as the horses go, that's pretty easy for us because the horses and the sheep don't commingle very often. And if it is incidental, if I take 1 bag of feed and from the sheep and give it to the horses, you need to record that. If you don't, it's kind of incidental expenses that you can not lose any sleep over. Okay, cool. So there are 5 basic kinds of business structure that most farming operations are. There are other business structures for operations, but they're like major corporation co-ops and things like that that we won't be dealing with. So we have sole proprietor. That's where you have started farming and it's just you. And you can have a doing business as farm name. You can register as an LLC if you choose to, but it's just you. I need to flip my slide here. You don't have to have any formal business structure, and all of the information from your farming operation goes on your Schedule F, which then flows through to your 1040 tax return that everybody files. A qualifying joint venture, like what Jim and I have in our operation, you have to be a married couple. It can only be the 2 of you. You cannot have an LLC, and you each file your own Schedule F. We keep our farming operation fairly separate. I take care of the animals, Jim takes care of the orchard. So whenever I file our Schedule Fs, I divide all of that out. I track it through the same QuickBooks accounting program, but I have it all divided out. So Jim knows what his stuff is doing. I know what my stuff is doing. If you're a married couple and you're both doing market gardening together and it's all commingled and it's 50-50, you can just split everything right down the middle, put those on the 2 Schedule Fs, and they go and are attached to your 1040 form, just like you normally would with any other income. They are a pass-through entity, which we're going to talk about that quite often. It's that the business itself is not its own identifiable structure. For tax purposes, the business is not taxed. The money flows through the business and the individuals in the business are taxed. A partnership, this is what Jim and I have in the distillery. We have our formal business agreement, our operating agreement. It states who owns what percentage of the operation, what their responsibilities are. We can include in there if we get any guaranteed payments, which was kind of like a salary, and all of the details. It includes also what happens if we dissolve the business. You can have an LLC for this if you choose to. The returns for partnerships is due March 15th instead of April 15th, and that's a deadline a lot of small businesses miss. So something to note. The income flows through the partnership. It goes on a K-1 form, and then that is given to each individual partner who puts that on their 1040 tax return. The S-Corp is a more formal business agreement. It takes a lot more record keeping. You have to have an annual meeting every year. You have to have very formal business structure, business practices, business records. For small producers, usually the amount of paperwork involved and the amount of effort that it takes to maintain all of that, it is not really feasible. You can get liability protection with an S Corp without having to form a separate LLC. They are structured so that they provide that automatically. An S Corp files an 1120S tax return with the Schedule F attached. The money flows through because it also is a pass-through entity, and it goes on the K-1, which is then issued to each shareholder. If you are an owner in the S Corp, you most likely will be notated as an officer. You will have specific jobs that you have to perform, and you have to pay yourself a reasonable salary. And a lot of S Corps get dinged on this because they want to pay themselves a small salary, because then the money that flows through to the K-1 is taxed less than the salary amount. So, excuse me. The IRS has very specific regulations in place that it has to be a reasonable salary, which a good rule of thumb is, if I was hiring someone to take care of my task, what would I have to pay them? Okay. A corporation, I'm going to skip that since we're still a little bit behind schedule, but a corporation is an even larger, more intricate, more difficult to track business structure than the S Corp. Oh, and S Corp taxes are due on March the 15th as well. Okay, I had a question submitted earlier that we are currently an LLC taxed as a partnership. I'm wondering at what point S Corp makes more sense. Well, the partnership does provide a lot more flexibility, because as far as money management, you can take money out and put money in, and it's not a problem. S Corp, there are some restrictions on that. An S Corp, you have to pay yourself the reasonable salary. So a good question is our business profitable enough and financially stable enough to pay me a reasonable salary? Because a lot of us, we're working for less than what we would get paid if we went and got an outside job, but it's a lifestyle and we enjoy it. And so that's what we choose to do. If you are planning to seek substantial financial investment from outside investors, if you feel like you need the maximum amount of asset protection, so more liability protection, and if you plan to become a publicly traded company. So if you're planning on really growing your business and really having a lot of assets involved and a lot of outside investment, an S Corp is a good idea. Otherwise, for most market gardeners, urban farmers, a partnership, a qualifying joint venture, sole proprietorship, those are better options because they're just easier to manage. Any questions on that?
There was a question about just if you know anything about getting liability insurance for U-pick operations, or maybe recommendations.
I do not. I do know that our basic farm policy gives us some liability protection for the farming operation. I think it's $100,000 or something like that. Also, I know that the state of Missouri, I've not looked specifically into Kansas laws recently, but the state of Missouri has some good laws on the books about if you're participating in a farming activity on someone's farm, you are restricted on what you can sue them for. That's a very non-lawyerly way to say it, but there are some good laws out there in Missouri. And I know that some of the ag organizations have those laws on their website, links to them, that sort of thing. Some of the insurance companies that specialize in farm insurance also promote those types of things. Any other questions? Okay. All right, now that we have our business structure and we're going to start keeping our records, do we keep them cash basis or accrual basis? And most farmers keep cash basis. It's easier, it's more straightforward. Whenever you receive money, it's income. Whenever you pay a bill, it's an expense. Very easy. Accrual basis is more complicated. in that you record the income when you earn the money. So if I have a lot of accounts payable and accounts receivable accounts, accrual is better, because whenever I earn the money is whenever I end the job and I invoice the client. They have 30 days to pay me on my accounts receivable accounts, but I record the income when I send out the invoice, not when they pay me. Same way with paying bills. The timing is when the expense is incurred. So if I put fertilizer on the garden, but I have 30 days to pay the co-op, I put the expense when I put the fertilizer on the garden, not when I write the check to the co-op. If you have a company that's $25 million or more, you are required to use accrual accounting. Otherwise, you can choose which one you prefer. Accrual does give you a better idea of money management and if you are making a profit or not. Cash basis accountants, more like your cash flow. Do we have money right now or don't we? It's less about, are we making a profit right now or are we not? What I do on our farm is I use cash basis because it's easier. And then I also do analysis by crop. And I just do these, I do them either outside of our accounting program, or I put classes in our accounting program that, like, this is crop 1, this is crop 2, so I can kind of track them individually in the background. And this is my example for that, because often I will breed animals, like here in December of 2019, I'm going to breed 78 ewes. And then during 2020, I'm going to care for the ewes. They're going to have 101 lambs. In the fall, I'm going to sell 25 of those lambs. So in 2019, I have expenses. So according to that financial statement, I took a loss. In 2020, I had a bunch of expenses and a little bit of income. According to that financial statement, I'm still taking a loss. But then in 2021, I'm going to sell the rest of the lambs. So my crop has spread over 3 years. And I need to know if that crop was profitable or not, because each year it's showing a little bit of a skewed picture on whether or not it was profitable under the cash basis. This helps us kind of track, particularly if I'm breeding ewes in groups. Did group A do as well as group B? Because if they're spread over multiple years and they're kind of overlaying each other on the financial statements, then if I only analyze it by crop, I don't really know what's going on. Okay, any other questions on cash basis and accrual? All right. Keeping records. I had several questions earlier, which I've put that at the end. It dealt with keeping records and how do I keep records? What are some recommendations? Those sorts of things. And there isn't really one correct method. It needs to be something that you're comfortable with, something that you can keep up to date, which is a very important thing. My recommendation is don't use your truck dashboard to store your receipts. I've known a lot of farmers over the years that that's where they keep all of it. And then once a month or at the end of the year, they're scraping all of the receipts off of the dashboard into a box to take to their tax preparer. Tax preparers don't like that. And a lot of them, including me, will charge you extra. You can use bookkeeping software. That way you can have financial reports, analyze those easily. You may need to hire somebody to do that in case you aren't comfortable with it. You may get some extra training. Excel spreadsheets work very well. Google Sheets the same way. They work very well. You can create income and expenses by category based on the information on the Schedule F. You can track your assets. You can do some analysis by crop, like we just discussed. Those are very user-friendly, achievable, and accessible for small operations. Ledgers, those work fine too. You know, just use a paper ledger, same thing. You have your different categories and you total them up. Bookkeeping services, a lot of tax accountants offer bookkeeping services, and people tend to shy away from it because they think it's going to be really expensive. But if you are valuing your time accurately, usually it's a pretty good use of money to just spend that once a month and know that you're up to date and on track. Also provides some outside input on how to categorize things, different ways to manage things, that sort. Do keep all of your receipts. Still need to keep your receipts for 7 years. Most tax activity on your return with the IRS and the state will occur within the first 3 years. That's usually whenever they're reviewing stuff, when they're recording it in their system, when they're issuing audit notices, those sorts of things. But there are a couple items like bad debts that they can pull tax returns that are 7 years old and come and issue you a letter about it. So it's good to have that for 7 years, just in case. Do keep it up to date. I cannot stress that enough, because we all think that we can remember what that receipt was for or what we charged Frank for that hay, but we really can't. And so then we're just guessing and our records aren't accurate and we don't really know if we're making money or not. And even though it's fun to farm, it is a business, so making a profit is the point. Okay, we're going to start now with the Schedule F. This is where all of your income and expenses will go for your tax return. No matter what kind of business structure you have, there will be a Schedule F if you're a farm. Schedule C is for other types of businesses, and then there's all kinds of different schedules for different tax activity that are attached to your main tax form, your 1040, your 1120S, etc. And this slide is just kind of a checklist for reference point for you to kind of know what things are. I will mention that the 1099 NEC is what the 1099 miscellaneous used to be. They changed the name last year. So for a 1099 NEC, that involves your contract labor. If you pay someone over $600 and they're not a formal employee, which we'll touch on that a little bit more later. The 1099 miscellaneous is now being used more for rent and other kinds of income that are not wages. And then the 1099G, if you're involved in any government programs, CSP, CRP, EQIP, you could be getting a 1099G for those payments. All of these need to go to your tax preparer. Okay, there's our Schedule F, and I have cut it up for a closer view because I couldn't see the full form on one screen. And this is the basic top portion. You got your name, your principal crop or activity. You got your social security number if you are a sole proprietor, qualifying joint venture. Partnerships sometimes even put their social security number on there depending on their legal structure. You can also have your EIN on there. And I get this question a lot too. Do I need an EIN? Which this is a tax identification number separate from your social security number. It's called an employer identification number. If you have employees, you will have to get an EIN. Otherwise, it's kind of optional. I have an EIN for my tax business, even though I am a sole proprietor. I do not have any employees. I am not an LLC, but some of the tax documents that I print out and give to clients, it requires that my tax identification number be on there. And I don't really want my social security number floating around in everybody's offices at home. So I have an EIN, and that's my identification number for my business. You can do the same thing if you're issuing the 1099 miscellaneous or the 1099 NEC to people. That way you don't have to put your social security number on there as the person issuing it. Partnerships, if you have a formal partnership business structure and or are an LLC partnership, an S Corp and corporations, they have to have one because they are considered kind of a separate business entity, even though it's still passed through for the income. Okay, these are the income categories on the Schedule F. And it is important to divide out your income categories because there are different places that you put them on the tax form. I have seen some Schedule Fs that have come across my desk from other places, and they've just got one giant figure up on 1A, which the numbers at the bottom will come out the same. But if you're ever in an audit and the auditor looks at that and says, okay, did you only have sales of livestock or other items for resale? And you're like, no, I'm a market gardener. I grow everything and sell what I grow. Then the auditor is going to take a closer look because obviously something's wrong because the number's on the wrong line. So let's see if these people really know what they're doing. So they will dig deeper and look at more details. Whereas if your Schedule F looks good and you've got everything divided out correctly and the auditor can see that, he may look at a few invoices to say, yeah, this lines up, and then sign off on it. So it's just easier to do it correctly, even if the number comes out at the end the same if you don't, just in case you do end up in an audit. So let's go through this really quick and hit some points. I've got numbers here that match the numbers on the Schedule F. On 1A, that is things that you have purchased and are going to resell. If I buy feeder pigs and I raise them and sell them as fat hogs, if I buy tomatoes from Tom and resell them at the city market, these are items that somebody else has, they've been born and or planted and harvested on someone else's property. Then 1B is going to be your cost. Even though this is the income section, we kind of do a little bit of a cost of goods calculation here. That's your cost of what you purchase those items for. And then 1C, that's going to be your taxable amount on those. 2 is going to be what you grew on the farm. So any tomatoes, any animals born on the farm, any tomatoes planted and harvested on the farm, that's going to be in 2. 3, that's for large corporations. We don't even need to know about that. And 4 is CRP. These are your government payments. If you're in CRP, CSP, EQIP, or anything else that you have worked with USDA and or FSA or any of their organizations that are under their umbrella, those program payments are going to go in here. And most of them are taxable. And I think that the Kansas City urban farmer community has learned a lot in the last 10 years based on how many questions I've gotten from people and the EQIP high tunnels, that money is taxable. Whenever you apply for and get an EQIP high tunnel and they send you a check, they're going to send you a 1099-G at the end of the year, and that is going to be taxable income. So it's something to remember whenever you're planning those things. 5 deals with pledging commodity as collateral for a government loan. Probably none of us will ever deal with that. 6, this usually is not something that people on our scale deal with because most of us usually don't have crop insurance. If we have crop failure, we just deal with it. This is geared more towards large row crop farmers, but with all of the COVID tax changes and all of the COVID payments that have gone out, a lot of small farmers last year and possibly this year did get some payments. I know FSA called me one day and said, hey, if you come in and sign up, we'll pay you for any hogs that you thought that you would be able to sell and weren't able to because of COVID, because there was a little processing issue with the plant up in St. Joe closing and everything. So I went in and signed up and they sent us a few $100s worth of hogs that we weren't able to sell, which was nice, but then I have to put that on the tax return. 7 is if you are hired by someone else to do any custom machine work. If you're the person in the community that has the tractor and you go and disc somebody's plot, then they're going to give you a 1099 NEC if it was over $600, and you're going to report it here on 7. Other income, something that was asked earlier was about grant income. If you have a SARE grant, if you have a value-added producer grant, anything like that, that money will go on line 8, and grants typically are taxable. Also, there is a lot of hubbub usually by new farmers and new business owners about things like the fuel tax credit and stuff like that. The fuel tax credit does exist. It's a little over 18 cents a gallon, but you can only claim the refund if you have at least a $750 refund. So I did the math here. If you divide 750 by 18 cents, it's going to have to be over $4,000 of fuel that you use just on the farm. So probably not going to apply to most of us. And then line 9 is our gross income. That is all of our income combined without anything taken out except our resale cost.
What about rent?
Rent, rent will be an expense.
Well, if you rent pasture.
If you rent pasture, you'll still be an expense. And we'll,
To someone? Yeah.
oh, you rent to someone. Excuse me, I did not understand. They will give you a 1099 miscellaneous for the rental amount, and you will put it on, if it is farm ground and part of your farm operation, you can put it on line 8, but you probably will put it on Schedule E for rental income because there's better tax advantage that way. Yes.
So on 1, let's say I bought tomatoes and then I took them to the market and sold them.
Right.
So I'm accounting for my income on line 1. So then down on line 9 where it says gross income, am I not, where's the tomatoes?
Okay, that's a good question. If we're on line 1 and we've bought tomatoes that we're going to resell, where does that money go? So line 1 is our income from those tomatoes. That's 1A. Line 1B is what we paid for those tomatoes. So line 1C is the amount of money we sold those tomatoes for, less cost. Then line 1C through line 8 are going to be added together, and that total goes on line 9, and that's your gross income.
9 is just totaling it. Okay.
Yes, 9 is just a totaling box.
There was another question.
Uh-huh.
Is the 1099 for contractors only for those you pay from your business? They had an example. Let's say you have your driveway redone at the farm. It costs $1,000. Do they need to issue a 1099 to the contractor?
Okay, if the question is, if you have a driveway done at your farm and it was over $600 that you paid the contractor, do we need to issue them a 1099 NEC? That depends. If the driveway is part of the farming operation or is necessary for the farming operation, if you have a big sorting shed back there that trucks have to come in and pick up your produce in order to take it to the wholesaler, that's part of the operation, even if that driveway passes by your house and you use it to go to your garage and park your car. We kind of get into a prorated point there. But if the business paid for the driveway, paid for it to be redone, if the business regularly uses the driveway, if it's over $600, you probably at least would want to prorate that between business and personal and issue a 1099 to the contractor for the business portion. If it's just your driveway at your house and you drive your farm pickup home and park in the driveway, you don't have to issue one. Okay, any other questions? I'm going to make a note here on value-added products. I'm also going to make a note on agritourism. Value-added products are not farming. According to the IRS, they have some very specific regulations on value-added. And They say that if you are processing something in the normal course, if you pick tomatoes and wash them, we run all of our apples through the washer. If you, let's see, handling, packing, grading, or storing on a farm, those are normal processing steps for ag products. But if you take the tomatoes and dry them and you're selling sun-dried tomatoes, or if you are fermenting your vegetables, or we make apple juice and sell it sometimes, those sorts of things, that gets into processing. Even if it's not like FDA level processing, it's still adding value to those products through processing. So the IRS considers those a separate business, not like in a formal structural sense, but as far as the income and expenses go, it's not farming. It's a value-added business. So all of those expenses and all of that income goes on the Schedule C, not the Schedule F. Now, again, this is a, you just want to fill the forms out right thing, because it's not really going to make a difference to the total at the end, because the farm is going to sell the produce to the value-added enterprise. The value-added enterprise is going to record an expense for buying those from the farm. Any of the jars or the electricity to run the dehydrator, etc., that goes on the value-added expenses. Things like that. So you're going to have a Schedule C, which looks very similar to the Schedule F, but it's has broader categories because it's for all businesses. You're going to end up with a net profit or loss over there on your Schedule C. You're going to end up with a net profit or loss on your Schedule F, and both of those are going to go on the 1040. So again, your bottom number is going to be the same, but if you do get audited, it'll be better to have the forms filled out correctly. Same way with agritourism. That's not farming. That is tourism. And so if you're doing educational classes, if you're doing tours that people are paying for, if you're renting your apple orchard for people to have their weddings, that's agritourism, and it is handled in the same way. It goes on the Schedule C, not the Schedule F. And if someone's paying to have the wedding in the apple orchard, then the value-added enterprise rents that portion of the apple orchard from the farm, and again, records it as an expense. The farm records it as an income, and it all is kept separate. So it's important to keep accurate records on those sorts of things, so that if you do get audited, you've got it all divided out according to the IRS regulations.
So is it all those kind of value added, because you made apple butter and then you had a wedding and people bought the apple and you, in the orchards that you did that, are those two separate businesses? So they're two separate Cs, or they're all on the same Schedule C?
Okay, that's a good question. If we're making apple butter and we're renting the orchard for weddings, is the apple butter enterprise one and is the wedding enterprise another? Not necessarily. You can have your enterprise labeled in your own business structure as event value added and agritourism LLC, or whatever you want to name it. But it's its own business.
It's one, it could be one.
It could be one business. If you wanted to really be intricate on dividing things out, you could make it two enterprises.
Would you still file a Schedule F as a farmer florist?
Yes, florists are considered farmers. If you are selling the flowers like at City Market or something, like many vendors do. But if you go to the dollar store and get a glass vase to put those flowers in and you sell the arrangement with the glass vase, that's value added.
Okay. Is a U-pick farming, or is U-pick farming or agritourism?
U-pick is usually agritourism. There's kind of a gray area there, because if you're not charging people to come and do a U-pick, if they're just coming and getting the produce and selling it, you can kind of get away with a little bit of, not get away, that's the wrong term. It's kind of okay to consider it part of your farming operation. But if you charge them $5 because you take them from the farm gate and they get to go on a hayride to go out to the orchard and pick, and the $5 covers the hayride and the U-pick, that's definitely agritourism. So it's kind of if they're paying for something besides the produce. Okay, any other questions? All right. Now we have our expenses. The expense category, I feel like, is more straightforward than the income category because it's kind of stuff we already track separately anyway. The car and truck expenses, this is your mileage rate. For 2021, it's going to be 56 cents a mile. Parking fees, tolls, if you choose not to use the standard mileage rate, and this is just for mileage for the farm, you can use actual operating expenses, but that's usually only done if you have a designated vehicle that is owned by the farming operation, that is only used for the farming operation. And even then, most of the time, it's better value to go with the 56 cents a mile than the actual operating expenses.
Sarah, can I just one question
Uh-huh.
before we move on? The flower one, so she said they sell at markets and do arrangements plus weddings and events. So would you say the weddings and events would be a Schedule C and then the farming would be the Schedule F?
Yes.
Okay.
Yeah. If we have flowers where we're growing flowers and we're doing arrangements that we're selling, and then we're also hosting wedding events, you would have some value added for the flowers. And this is if you're doing an extensive arrangement with bows, or you have dried some of the flowers and done that. If you take your flowers and put them in a nice pretty bundle and set them out there and sell them and don't have any cellophane or anything, you're probably not classify that as value added. But if you do something more extensive, it is the weddings and events, definitely ag tourism.
When can you record the mileage, like what activities, for example, delivering product, that's eligible?
Right.
Yes, that if your farm is, you don't live on your farm, driving your farm, ineligible?
Good point. Okay, when do we record mileage? If you live in town and you have a plot of land out that you're farming, driving from your house to your farm is not mileage, because the IRS says people that work a job 9 to 5 for somebody else, they don't get to deduct their mileage whenever they're commuting. So why should farmers get to deduct theirs? It's fair. But if you go from the farm and make deliveries all around Kansas City and go back to the farm, all of that mileage counts as farm mileage. If you go from home and you go and run errands and come back home and the errands are just for the farm, that can be farm mileage. Now, this is where it gets tricky. If you leave home, go to the farm, go and run errands and go back home, not all of that is farm mileage. You have to deduct the commuting miles, round trip. And the IRS, in an audit, they want to see the date that you had the mileage, the starting odometer reading, the ending odometer reading, the total number of miles, because they don't want to have to do the math, and I don't blame them, and what the purpose of the trip was. Were you making deliveries? Were you running errands? Were you going to buy seed? What were you doing? So that's a good question.
And what do most people have some app that?
There are some apps out there that are very good apps. Most of the ones that are easy to use, you have to pay a monthly fee for, I'm told. There also are books that you can buy that they are printed books for mileage logs. Some people just print out blank Excel spreadsheets and use that. That's what Jim likes to use. It works for him. That's fine with me.
So again, just to verify, commuting to and from the farm, is never counted as mileage, even if you have to go multiple times a day.
Correct. Commuting is never mileage.
Okay.
Okay. Number 10 is chemicals. Any chemicals that you buy for your farm, they go there. Soil and water conservation expenses and endangered species recovery. You can add these to the basis of the land. Like if you build a pond, that's considered soil and water conservation. Most people will take that expense and add it to the value of the land, not expense it out. It's kind of by choice. It's usually a better option to add it to the land because you can't just sell off the pond. And so having a separate value for that is kind of difficult. For 13, custom hire. If you are the person that has hired the member in the community that has the tractor and the disc to come and disc your garden plot or plow it or however you're working out your soil management that year, that's your custom hire. If you pay them more than $600, you will need to issue them the 1099 NEC. Depreciation, we're going to talk more about that in a minute. 15 is employee benefits programs other than on line 23. So if you have full-time employees and you're offering health plans and group term life insurance, that sort of thing, it goes there. 16 is feed. 17 through 19 are pretty self-explanatory. And so is insurance and interest. Labor that is hired, we're going to talk about that more. Contributions to employees' pensions, profit sharing or annuity plans. Again, if you have full-time employees. 24 is rent. This is where you would put your expense for renting someone's pasture or renting a garden plot. And if you're paying them more than $600, you would issue them a 1099 MISC for that expense. There's all kinds of documents that have to float back and forth. And the reason they require that is because whenever you issue that, a copy gets sent to the IRS. So this is kind of the IRS's double checking method. Anytime anybody is issued a 1099 or a W-2 or any other tax form, a copy gets sent to the IRS. So then they know that if Farmer Joe says he didn't make any money on his farm, but Tom says that he paid him $10,000 for custom hire or whatever, the IRS is probably going to audit him. There have also been instances, and it's not uncommon, that whenever they start looking at this farmer and his stuff isn't accurate, and then they start looking at this farmer over here that he's done business with, it's kind of a domino effect. But the auditors are usually pretty easy to deal with. They're just trying to make sure things are accurate. All right, repairs and maintenance, seeds and plants, storage and warehousing, supplies. So they're all pretty self-explanatory. 29 is taxes. This can be your real estate tax, your personal property tax you pay on your tractor, etc. The employer portion of Social Security and Medicare that you have paid for employees' wages, unemployment insurance. If you are doing the federal highway use tax for very large vehicles, it goes here. My rule of thumb for clients is if you paid a tax, tell me about it, because the rules change every year on these things. So let me know and I'll let you know if this year we can take it or not, because there's no point in having expenses that you don't deduct on your return. Okay. 30 is utilities. Well, where's the rest of my list? Apparently, I have skipped a slide. Well, 30 is utilities. If the farm is not separate from your house, you'll need to prorate the utilities that are used by the farm for water to wash vegetables, whatever. An easy way to do this a lot of times is like in the wintertime, you probably aren't doing too much in your garden. So you can kind of get a baseline of how much water the house uses. And then anything above that in the summertime, you can say that's for the farm. And the IRS is pretty good about accepting things like that usually. There is the Cohen rule that we reference a lot, that if you consistently record, it's a legal case that they fought out in the 1930s, I think. But if you consistently record something one way and it is a reasonable way to record it, they will accept it. Now, if one year you say that the water was 50% farm and the next year you say that the water was 100% farm and you don't have any baseline for it, they're probably going to disallow the whole expense. Veterinary breeding and medicine, again, anything that goes into the animals. And 32 is other expenses. This is anything that does not fit in the previous categories. Some tax preparers think that it's better not to have anything in that column. They feel like it cuts down on the number of audits. I personally have not seen that. I am more apt to put quite a bit of things in 32 because small market gardens, urban farmers, they don't really fit the mold established by the IRS, who's used to dealing with giant row crop farmers in Western Kansas and things like that. So I'm more apt to list out the things in 32 because I want the IRS to see we've tracked things, we've tracked them in detail, and we have the information. But again, neither way is correct or incorrect. Okay, any questions on part 2? We are going to go over depreciation, business use of home, and labor in more detail.
I have about 4 questions from the chat.
Okay.
How do you record income when you charge for delivery and shipping?
You will, okay, how do you record income when you charge for delivery and shipping? Those are services provided by your farm. So they are going to be other income, which is going to go on line 8. And you can, we charge for shipping. We don't charge for delivery, but we do charge for shipping. UPS flat rate box is $16.15 for the size that I ship. I charge people $17 because it's easier. I record $16.15 as my shipping expense. I record $17 as my shipping income, and they both go on the other line in the appropriate section on the Schedule F.
Can driving around the farm be counted as mileage?
Can driving around the farm be counted as mileage? Yes. If you're doing farming activities and you're taking the standard mileage rate, not your actual expenses on the truck. But if I own 200 acres and had to drive around every day in order to check all of my sheep, because it would take too long to walk it, I can count that mileage.
If you rent a machine to regrade your land to manage water and level fields, can you put that into a conservation expense?
Okay, if we're renting a grader for conservation purposes, do we put that in a conservation expense? You can, yes. Particularly if it is part of a government program that you're in. If this is your CSP practice that you're supposed to grade this so that they give you your CSP payment at the end of the year, then yes, it would be a conservation expense.
If you drive from the farm to the farmer's market to sell, is that deductible mileage or commuting?
Driving from the farm to the farmer's market to sell, is that commuting or is that mileage? If I would say yes, it is mileage. Some tax preparers might say that it is commuting if you live on the farm because you're driving from your farm to where you're selling. I would say that it is mileage because you are transporting your produce.
Do you keep track of orchard trees separately? I think I might need to get more clarity on that.
Do you keep track of orchard trees separately? That's a good question. Orchard trees and vines are depreciated. They are not an expense. Like your seeds, and if you buy tomato starts and that sort of thing, those are an expense under seeds and plants. Fruit trees and vines are qualified as assets. However, with fruit trees, you do not start the depreciation until year 3 when they start producing. So we have trees on our orchard right now that we keep putting money into, and I keep adding up what our asset value is, but we've not been able to take any depreciation yet because they're only 2 years old.
Okay, and then do you prorate real estate taxes or do you deduct the whole amount?
Do you prorate real estate taxes or do you deduct the whole amount? If you live on the farm and pay real estate taxes on that, you should prorate it based on acreage, or sometimes the real estate taxes, depending on where you're at and what you're doing, sometimes they divide out the house and the farm, and so you do need to prorate it.
Yeah, she asked, how do you figure out the prorating? So I guess based on acreage, or it might be prefigured if the house is separate.
Yes, I would do it based on acreage. I think that is the most straightforward, reasonable, provable calculation if the IRS questions it.
I think sometimes your real estate taxes or your appraisal.
Yes.
Not your taxes, but the actual appraisal, it'll break it out. It'll say that you have a house that is this many square feet, and here's the value. And then you have a barn that's,
right,
outbuildings, and then here's the value, so you'll be able to.
Yes, some real estate taxes do have the valuation on there where things are line items. But the thing to watch on that is if it says that you have 15 acres of land, but you're only using 5 acres for your market garden, only the 5 acre value is what you prorate. So that makes it easier though, if they're already broken out somewhat.
Okay, and then this is a good one. Are chickens for eggs an asset that is depreciated, or any other livestock, I guess?
Livestock is kind of a fun thing with depreciation. If it is a breeding animal, it's depreciable. And chickens, you can depreciate chickens, I found out recently, because we had someone that lost a bunch of their chickens and had to calculate what to do about that. If it's breeding stock or it's the chickens that lay eggs, they are a depreciable asset. If it is animals that you raised from the farm, like you, whenever I was growing my sheep flock, I had my ewes, I had purchased them, they were breeding stock, they're depreciable. Whenever they had lambs that I kept back as replacements, even though it's breeding stock, I didn't purchase it. And so it's not depreciable because the IRS feels that you already expensed everything that it costs to raise that animal. And so you shouldn't also get to depreciate the value.
What about bees?
Bees are kind of an entity in and of themselves. Yes, they are. Beehives are depreciable. They have, I think it's a 3-year life that they allow them. So your depreciation based on the cost of a beehive, usually you end up doing bonus depreciation on that and take the full value in the first year. But technically, yes, they are depreciable.
Compost expense?
Compost expense goes under fertilizer.
And then what about the cost of travel for a farming conference?
Cost of travel for a farming conference is probably not a deductible expense unless you are presenting or you are a vendor at the trade show or something like that. If you're just going to it, it's difficult to prove that it is a necessary expense for your farming operation. Usually they go by like certificate requirements. Like I'm an enrolled agent, I have a certificate. In order to maintain my certificate, in every 3-year period, I have to have 72 hours of continuing education. So whenever I travel to a conference, I get to deduct those expenses. But for farmers, since there is not a certificate that they have to travel to the conference, the IRS, because a lot of us combine our vacations with the conference, doesn't allow people to take that expense.
One question about kind of similar, so if fruit and vines are depreciated, there's a flower farmer that plants perennial flowers that don't produce for 3 years. Would that be the same? The example she gave was peonies.
Yes, I think that you could depreciate peonies. They don't produce for 3 years. I don't know that you would be able to wait to take the depreciation, which isn't necessarily a bad thing. I would need to dive deeper into the regulations on that because fruit trees and vines are specifically stated in the regulations, so that's an easy one. Peonies and market flowers are kind of in a gray area, so I would want to look at the regulations before I gave a definitive answer on that.
Okay, back to the chickens. Even though chickens that are laying can be depreciated, can you just expense the purchase and the feed, etc.?
Okay, this is a good place to start a depreciation schedule or discussion. Okay, this person's question is, I have laying hens with eggs and I'm going to depreciate the chickens. Am I expensing the feed and the purchase costs? Am I getting this correct? Okay. The feed is an expense. Yes. Line 16, feed. You'll have the total for the year and you'll put it in there. The purchase price is your basis in the chickens who are your asset. So your purchase price is going to go on your depreciation schedule. And the IRS has farm property recovery periods that these are outlined by the IRS for tax purposes. You cannot stray from this. Even if you think that your agricultural structure on the top line will last for 20 years, you have to depreciate it in 10. That's just the way it is. For the chickens, you're going to take your purchase price and divide it out by the number of years. This is recovery period in years is the GDS system or the ADS system. So it's a little bit complicated than just dividing it out and the same amount goes to every year because it's you have double declining and straight line and different classifications. But the basic concept is you take your purchase price and you divide it out over the years of the recovery period, but maybe just not evenly.
So chickens, a lot of times you replace them every 2 years.
Right.
That's such a short period of time.
Yes.
Is it better just to expense them out?
The question is, since chickens usually are replaced every 2 years, is it better just to expense them? This is where bonus depreciation comes in. And they've made a lot of changes to bonus depreciation and what they call Section 179, because that's the section that covers depreciation. And they've added on some extra bonus depreciation options for farmers. And it's gotten very big and convoluted. But you still put the chickens on your depreciation schedule. Their recovery period is still 2 years. But then you take bonus depreciation, which means that because they fall into this specific category outlined by the IRS, you are allowed to take the entire depreciation amount in year 1. So according to the IRS, you're not expensing them, you're taking bonus depreciation.
Okay, a couple more questions from me. When
Okay.
you're a board member of the organization that is planning the conference, can you take mileage from that?
A board member who is planning the farming conference, can you take mileage from that?
Yes.
I would say only if you are being paid as a board member or to plan the conference, because otherwise it is not a farming expense.
Second question is, it's like a word problem. If you had a huge orchard on your property and depreciate your trees
trees on your partnership return and then sell your property, you would need to recapture the depreciation, right? But the value of the trees is likely being included in the reporting of the sale of the home, if it is your primary residence. So the closing document and the reporting of the IRS will show the purchase price of the real estate, including the value of the trees in it. How does the portion of the real estate transaction that should be going toward the value of the trees get applied to the business return and not the homeowner portion of the personal return?
Okay, she spent that whole time reading the question. You guys may not have been able to hear her. It's obviously a very long, complicated question, and so I'm going to say, email me on that. Because it sounded like a very good question that dealt with depreciation, recapture, and valuing your home versus your farm assets, especially with an orchard. So it's good things to ask, but it's a broader topic than what we're discussing today. Speaking of which, it is 2:30. We are halfway through the slides because we had some really great questions. What topics do we want to focus on? Because we're not getting through all of this. I have depreciation and labor, business use of home.
If people want to respond in the chat with their preference, let us know.
Okay, if people want to respond in the chat, that would be great. If we want to skip ahead and actually talk about the taxes themselves, we could do that. Yeah.
2 votes for business use of home.
Okay.
I think a lot of people might fall into that category.
Okay, I'm just going to keep going then. I did design these slides as a reference kind of material, so you can read through them and hopefully it will kind of explain itself to some extent. If you get bogged down in it, you can email me and say, what did you mean on this page?
Business use of home, taxes, and labor were the 3.
Business use of home, taxes, and labor. Okay, then I'm going to skip on through depreciation. You can read the rest of the examples there if you want to. And we're going to go to business use of home. Business use of home is a great thing. It's also something that is abused a lot because people don't understand it, because a lot of us use our kitchen table as our desk. Things like that happen. And so it's difficult to be able to prove that this was for business use. So the definition is if part of your home is regularly and exclusively used by the farm. So if you have office that you do all your farm management in, you pay your farm bills, that sort of thing, that's easy to prove. It is exclusively and regularly used by the farm. If you sit on the couch and do the same activities, you can't take the expense of where the couch sits as business use of your home because you're probably also watching TV or talking to your spouse or your friends or your children or whoever. So, must be used as a principal place of business. Are we having problems?
51.
Oh, sorry. Okay, I was flipping through slides really fast then. All right, so exclusively and regularly used as your principal place of business and or a place that you meet with clients. I have an office in our house that I meet with tax clients. I expense the office as business use of my home for my tax practice because other business operators have similar regulations as to the farm business use of the home. You can have another place that you conduct business, like if you have a short sorting shed that you also pay some of your bills out there because they drop seeds off and you're writing a check to the guy so that he can go with it. That's okay, just so long as you have a primary place where you pay bills and send invoices and things. Also, if it is a separate structure that is not attached to the house, like a freestanding garage, a greenhouse, a storage shed, a barn, you can take that as business use of your home if it is on the farmstead. Now, if you just have a farm plot somewhere that you don't live on and there's a barn there, you're going to depreciate the value of the barn because it's considered a farm asset. It's not part of your home that you live in down the road. And here is a very nice flow chart that if you aren't sure if your business uses the home or not, then this is a very good flow chart that kind of helps you yes or no and figure out what you're doing. Something I did add to the flow chart is down at the bottom, it says, is it a separate structure? And according to the flow chart, if you say no, it says you don't get a deduction. But there is a clause in there, which this is tax rules are constantly changing. So maybe the flow chart just hasn't caught up yet. That if you have inventory or samples that you're storing in the corner of your living room, and that's where you always store them, and that little 4x4 area is your inventory and samples, you can take that as business use of your home, even though it's not a separate structure. To calculate business use of your home, there's two methods. I strongly recommend the simplified method because it's more simple. But you can do actual expenses. And to do that, you deduct 100% of the expenses that only use for the business part of your home. So if I paint my office, if I have to repair a window in my office, those sorts of things, I can deduct that full cost. But expenses like the electric for the lights in my office and to run the printer, real estate taxes, insurance on the house itself, that has to be prorated. And so you have to be able to say, for my office, I use this portion of the electric. Usually it's done by square footage is the easiest way to do that. And you cannot deduct the expenses that go to the portions of the house that are not for business. So like lawn care, which I got into a big discussion with a client one year on this. She planted flowers outside of her house where she had I think it was a beauty salon, a little, people came and she cut their hair. And she told me she would not plant those flowers if she didn't have the beauty salon, so they were a business expense. And the IRS says, no, they're not. That's your personal yard out there. It has nothing to do with this area in here where you're conducting business, even if you only plant the flowers to look nice for your customers. The simplified method, which I love the simplified method. You determine the square footage of the area that you're using for business. I do this for us. I do a business use of my home for my tax practice. Jim has another office that he uses for the farm operation. We take business use of your home as our farm office on that. There is a 300 square foot limit, so you can have a pretty good size area. And it's $5 a foot. So most of us, we couldn't get to that number with the actual expenses anyway. So the simplified method is better value. The thing to note about the business use of home is you cannot use it to take a loss. So if you get to take the full 300 square feet, so we're talking $1,500, and your net profit on the Schedule F before you take business use of your home is $1,000, you cannot take a loss then of $500. You can zero it out. You can take 1,000 of it, but you can't take that extra $500. It can be carried forward to more profitable years, but it cannot be taken in the year that it's occurring. Okay, I have a question that was submitted earlier. I'm wondering if I should skip it. Do we have questions in the chat?
There's just one about employment, so I think
Okay.
that's fine.
All right, guidance for when the farm uses part of a residence that is also rented out to a non-farm involved tenant. The farm shares the kitchen, sole use of the finished basement, the bedroom, the mudroom, and the unfinished garage. The farm electric is all together with the tenant. So then let's see, And then the second question is, how does the game change if the tenant leaves and the farmer starts living in the house? So I needed some clarification on this. I didn't think that it looked like it was the farmer's main home, but I'm going to kind of give two examples. If this is the farmer's main home and he's living in a portion of the house, the tenant's living in a portion of the house, and the farm has use of these areas of the house, you have to ask yourself, is it exclusively and regularly used by the farm for farm purposes? Probably the mudroom's going to really come into question, because most of us go in and out of the mudroom to get to the living room or the farm office, and we do keep our boots there, but you would probably keep your boots there even if you didn't have a farm. So probably wouldn't have it. The kitchen and the garage will probably be the easiest to prove in the case of an audit. The bedroom, the basement maybe, but it sounds like it might be more than 300 square feet. It also sounds like it's going to be difficult to divide out the electric because it's used for the whole house. And so I would highly recommend use the simplified method. Make sure the area is exclusively and regularly used for farm purposes, only farm purposes. And I would have a designated area. If the farm uses more than 300 square feet, since we're going through several different rooms of the house, I would have a designated, okay, we're expensing the kitchen and the north end of the basement, and that's our 300 feet. Some tax preparers even recommend in situations like this, you take a picture that has a timestamp in it every year. They recommend this a lot for like ladies that do Mary Kay at home, and they say they have an in-home office. Take a picture so that if there is an audit, you can say, yes, here is my office in 2015. I think that's very, very intricate, detailed records, but it is an option. Okay, so that's if the farmer is living there. If the farmer is not living there and the house is on the farm property, it's probably going to be considered the whole thing as a farm asset, and the farm is now renting property to this tenant. I'm assuming the tenant is paying rent. So you're going to depreciate the house as basically your barn structure, probably, because it sounds like it's a processing facility for the vegetables. And you're also going to have rental income from this tenant, and you're not going to depreciate that portion of the house. You're going to prorate the amount. And so it kind of gets complicated there as to whether it's the farmer's home or whether it is a house on the farm separate from his home.
I have a few quick questions.
Okay.
Is the business use of home calculation on Schedule F Part 2?
Is the business use of home calculation on Schedule F Part 2? No. Because business use of home is not only used by farmers, it's used by other business industries. It's on its own form. And I think offhand it is Form 8812, but I could have my number incorrect. If you Google IRS form business use of home, it will come up. The IRS is very good with their SEOs, and you can get easy results when you're Googling stuff.
Can you change from actual to simplified from year to year for business use of home?
Can you change from actual to simplified from year to year for business use of your home? Yes.
Okay.
But a footnote on that is back to the Cohan rules. The IRS likes to see consistency. They feel like if you're consistent, then you obviously have a plan and are working to keep accurate records, and they feel more confident in the information you're providing them. So if you have been doing actual and think, oh, well, we need to do simplify and switch over, that's not a big deal. But if you're switching back and forth from year to year in an audit, they might kind of wonder why.
Someone is using a part of their home that's not officially counted in the living space, like an unfinished basement. Would they just calculate the square footage of that and use that?
Okay, we have a unfinished basement that's being used for the business. Do we count that as business use of home? Yes, because it is part of the structure.
Nancy asked, if I sell my home, do I need to recapture the depreciation? Wait.
Didn't it used to be you could also depreciate part of your home office?
Let's pause. People are having sound troubles.
Depreciate that section of your home also that you took the expenses for?
Whenever you take the actual expenses, depreciation can be part of that, yes. You prorate the
And then when you sell your home, do you have to recapture that depreciation?
No, because this is one of those odd IRS regulations again. You're not taking business depreciation, you are calculating the cost for the business use of your home, so it is an expense, not a depreciation, business depreciation calculation. Are we good?
I think so.
Okay.
Everyone says we're good.
When I first started studying accounting and taxes, particularly taxes, somebody told me one time, in taxes, you don't look so much as the big words as you do the little words. And so that question was a good example of that. It's more about the and, or, may, will, than what the big words are.
Great. There was a question about labor, so I don't know if you want to spend the last bit of it maybe talking about farm labor.
Okay.
The question was, if I pay someone less than the $600, should I still deduct it?
Okay. They're asking if they pay someone less than $600, should they still deduct it? Yes, but you don't have to issue a 1099. On labor, there are employees and there are contractors. And a lot of small business owners like to say, oh, everybody's a contractor because it's so much easier. They don't have to run payroll, they don't have to do withholding, they don't have to have a regular set pay schedule. They can just, if we've had a really good week, I'll pay you for the next 3 weeks instead of just the last 2. The IRS is very strict on this because the IRS, their only function is to make sure that the taxes get paid accurately and that the government has the tax money so that they can function. These are the regulatory reasons. So they also are concerned with timing. If somebody is an employee and you should be withholding taxes from their paycheck and paying it to the government quarterly, and you instead pay them as a contractor and then their taxes are calculated on their tax return the following calendar year, the IRS gets really, really big sticklers on that point. Am I moving on my frame? Oh, okay. So that's part of the reason that this is such a point for them to focus on. And also because it's an area where a lot of people kind of fudge the rules. So for an employee, if you have direct control over the work that they perform, and if you control the financial aspects of their job, if they receive any fringe benefits, and you expect the job will continue indefinitely, the services are key to the business, even if they're seasonal workers, that's an employee. If they have control over it and they have control over when the work done, if you tell Joe, I want you to build a barn, and Joe is responsible for the timing and the finances and everything, that's a contractor. Those are the main differences. Kind of already covered that.
What number of slide are you on?
I am on slide 59.
Thank you.
Okay, and so for the employee, you're going to process payroll, you're going to withhold the employment taxes, and the employee portion of Social Security and Medicare. And you're going to submit quarterly reports to pay in the taxes. You have to issue them a W-2 by January 1st of the next year. For the contractor, you pay the contractor, you retain all your records, and then you issue a 1099 NEC, again due by January 1st of the following year. There are penalties for not issuing that 1099. I believe that there are $50 per 1099 that should have been issued unless they have increased them. But they usually, whenever they start looking at stuff like that, if they can get you on that, they start digging a little bit deeper to see if they can get you on something else. Then you end up with penalties and then interest for taxes that should have been paid. So it's easier just to issue the 1099s. Some contractors don't want you to. And so whenever I'm dealing with a contractor, because some of the fence builders in our area, they don't want a 1099 for whatever reasons. And I tell them up front, that's part of the requirements of building my fence, is I'm going to issue a 1099 at the end of the year. And some of them don't work for me. But then I don't get in trouble. And particularly as a tax preparer, I don't want to get in trouble. Okay, we had a question earlier. Do we have any questions in the chat box we need to do instead?
Mary, we'll do the next slide. There's a delay.
Oh, okay.
There you go.
All right. How to calculate tax withholding on seasonal part-time employees. If it is an employee and not a contractor, which you can go back and look at the other slides, seasonal employees are the same and part-time employees are the same as a year-round full-time employee, because you control the finances, you're directing their work. Even though it's seasonable, it is expected that they won't just come in and build the barn. They'll come in and help you build a barn, and however long that takes, they will work until the end of the season. So indefinite still applies in that scenario. So you have to do payroll for them, do the withholding, issue regular paychecks, etc. Okay, do we have any other questions?
Self-employment tax.
Self-employment tax. Okay, then we're gonna skip forward to slide 72.
I think I'm there. Yep.
Okay. Self-employment tax is Social Security and Medicare that you are paying in. A lot of people like to have, not a lot, I have encountered a lot of people, my father was one of them, who doesn't want to pay taxes. So he made sure that for most years he didn't make much money on the farm. The catch to that is once you hit retirement age and you want to collect Social Security, you haven't paid in much. So you aren't going to get much out. So it's something to think about whenever you're deciding if you want to pay those taxes or not. You pay Medicare and Social Security on your tax return for self-employment tax. We're on slide 73. Just like employees with W-2s have Medicare and Social Security withheld on their paychecks. Now on the employee side, the employee gets half of it taken out of their check and the employer puts in half of it. On the self-employment tax side, you calculate the full amount on your tax return and you are able to deduct half of it, but it's in an interesting spot on the tax return calculation. So it's not a dollar for dollar deduction. And I'll hit that in a minute. The employee also has their federal income tax, state income tax, and if you're in Kansas City proper, earnings tax taken out of their paycheck, whereas self-employed individuals pay that all at the end of the year with their tax return, unless they're doing estimated tax payments, which there's a slide in here on those. If you earn more as net profit, $400 or more, you qualify as being self-employed. So that's something to keep in mind. even if you're having a bad year or something, still file your Schedule F, even if you don't have to pay self-employment tax. It's good to have those records. Let's see. S Corp officers, they're a little different. They get a W-2 and they don't have to pay self-employment taxes. So there is some slides in here on that. I thought I had a slide here. Okay, here, slide 78. This is where the half of self-employment tax that you're able to deduct on your tax return gets interesting. Because on this 1040, the basic calculation is you come up with your total income amount, and then half of self-employment tax is subtracted from your total income. That gives you your adjusted gross income. That flows through to your taxable income. You take your taxable income and you use your tax rate charts or your software, and you calculate the tax amount. Then that is the point that from the Schedule SE, where you calculated how much self-employment tax you are paying, that's the point that you add the full amount back in. So you were able to deduct half, but it was way up in the calculation where we added the full amount down at the end of the calculation to get total tax. So it's not a dollar for dollar halfway deduction. I just wanted to point that out. Okay, any questions? Got about 7 minutes.
What if the farm and the operations are shared by a couple? Does the income get split between the two for self-employment calculation?
Okay, what if the farm is owned by a couple? I'm assuming they're married. Okay, we're going to assume they're married. If they are married, they can do a qualifying joint venture, or they can do a partnership. Regarding self-employment tax, it will depend on their percentage ownership in the operation. So then you would have your net profit calculation on the Schedule Fs, and you either, depending on if you're a partnership or a qualifying joint venture, you'll divide out, like with the distillery, Jim and I are not equal owners. So at the end of the year, we divide out, he gets his percentage of the net profit, I get my percentage of the net profit, and then self-employment tax is figured on those values. Because self-employment tax is calculated on your net profit.
So do you have two self-employment tax forms?
Yes, you would have two separate
One with your name and
self-employment.
one with his.
Yes,
Which tax table is used monthly if paid only once? I don't know if that's a question about farm labor. Do you understand that?
which tax table is used monthly if only paid once? I think this sounds like a employee payment. They're only being paid once for the season, probably seasonable labor. There is a tax table that it is for annual salary. I would use that one if you're only paying them one time.
Those are all the questions that I had in the
Okay.
Q&A, but I'll see if anyone has some questions.
Okay. Some of the questions that submitted earlier, that's, you found the slide. Okay, cool. We had 4 different questions that I felt like kind of dealt with the same thing. It is best practices for small and beginning producers regarding reporting requirements, top 3 recommendations to navigate taxes, long-term tax strategies, and having a tax advisor that can help make the best decisions regarding tax breaks and benefits for a brand new farm. And for everyone, I think that it is very important to have a relationship with a tax preparer that you trust. They don't have to be the fanciest, they don't have to be the most expensive, or they can be. That part doesn't matter. It's if you're comfortable with them and you can discuss your tax and business concerns with them and get answers that you feel like are reliable. That's the important part. Keep up to date and accurate records,
because like I said before, we all think we're gonna remember what that invoice was for or what the note scratched onto the torn corner of the feed sack meant, but we're not. So keep accurate records. I recommend updating your records weekly. Have a day in the week that Monday morning, that's what you do, is input all the stuff. And before any significant financial decision, this is across any tax decision, talk to your tax preparer. We have people every year that come in and they've taken money out of their 401k, or they've sold something, or they inherited something, or some giant financial thing has occurred, and they didn't come and talk to us first, and we could have saved the money on taxes. We could have helped them navigate a little bit better. And a lot of times they end up with a big tax bill at the end of the year, and then they're upset because they didn't know. So it is so much better to talk to your tax preparer ahead of time, be proactive. Even if they tell you, yeah, great, you've got it figured out, do what you're doing, it's good to know. Tax time is not a time to surprise